Thanks for joining. We're going to be getting started in just a moment. I'm going to give everybody just a second to get in and get situated. But while we do so, going to get started with some introductions. So joining us today, we have Nico Pavlo, a product marketing manager, and Natasha Kapoor, our sales engineer, who are going to be walking through home equity is the proving ground. How digital first origination will define the next era of lending. Just for time's sake, I'm going to go ahead and pass it over to you, Nico. Feel free to get started.
Cool. Well, thanks, Christian. Hello, everybody. Super excited to be talking with you all today. And so what we're going to talk about today is how home equity is the proving ground for the next era of lending. Not eventually, but right now. And specifically, the borrowers you want most. Strong credit, real equity, clear intent. They're making decisions faster than your timelines allow. And fintechs are capitalizing on this and winning those borrowers. And so the question becomes for every institution out there, are you positioned to compete, or are you watching someone else take your best customers? And so that's what we're going to jump in to today. We'll talk about how to win, and then we'll also see some things in action and what we can do. So specifically, there are three things that I really want to dive into today, and that is speed, and some more speed. And so the thing is that speed is the critical component driving the current market landscape. It's fueling not only the current market landscape, but it's also the foundation for the next era of digital lending. And so I think this is such a great way to represent the current market landscape and what it looks like. The current market for home equity origination is all about speed. Speed for the borrower acquisition, speed of application, speed of digital closings, as well as speed to credit decisioning. Digital solutions are so much faster than their traditional counterparts. And what we're currently seeing in the current market landscape is that digital solutions are pulling ahead. And if a picture is worth 1,000 words, perhaps a meme is maybe worth 10,000 words. Plus, who doesn't love Usain Bolt, right? But also, I always love in those movies where they start off, with that whole, yep, that's me, freeze frame. You're probably wondering how I ended up in this situation. So let's actually figure out, how did the digital solutions end up in this situation? How are they able to pull ahead and create such a differentiation? So meet Andy America. Now, Andy definitely doesn't look like me, but Andy's a hypothetical scenario here. 42-year-old software engineer, great income, great credit profile, great equity in his home. By every measure, a really, really great borrower. But Andy's running into some challenges. Life happens. And so he's racked up about $47,000 on his credit cards. And so with interest alone, he's looking at about $1,000 a month in interest payments. And so Andy wants to leverage the equity he's built up in his home to restructure those credit card balances into a lower rate through a home equity product. And so Andy has two options. Andy could apply at his bank. They're offering him a great rate at 7.5%. They're going to waive the origination fees because it's a great relationship for the bank. But the catch is that Andy's going to have to wait and close after 40 plus days. On the flip side, Andy could apply to one of these various different fintech providers in the market. He's never really heard of any of these companies, but they're promising him a firm offer within 5 minutes, and that he could have his cash in his account on day 10. But the catch is that he's going to have to take a higher rate, and he's also going to have to pay an origination fee, and he's also going to have to go with a company that he's never heard of before. What do you think Andy chooses in this situation? Andy chooses speed. Andy chooses a 10.5% rate over 7.5%. He chooses to pay $2,300 in origination fees versus not paying anything, zero. And he chooses to go with a 5-year-old fintech he's never heard of before over his bank of 15 years. And it's not because he doesn't love it. He actually really loves his bank. It's because his bank couldn't help him when he needed it most. And he wanted the cash now and needed the cash now. And on paper, this almost seems a little bit maybe irrational. Why would you take a higher rate and pay an origination fee over the interest you would have paid if you just held on for a few more weeks? And this is the experiment that we're seeing play out across every segment of the market right now in home equity. In real time, borrowers in many cases are choosing speed over rate, speed over cost. And I know with the counter argument that maybe some of you are all, hearing this and you're kind of thinking, hold on, Nico, hold on. This is one hypothetical borrower that you're illustrating here, Andy. He's only one, it's only one borrower. So that's true. Andy is just one borrower. But let me show you what 8.3 billion worth of Andy's looks like. Over the last 7 years, Figure went from 0 to 8.3 billion. They were the 6th largest home equity lender in 2023, the 4th largest lender in 2024, and it'll be super interesting to see where they rank up with 8.3 billion in closings in 2025. But what's super interesting here is that they've managed to do all of this with higher rates, higher origination fees, and it's pretty clear they're not winning on price. They're winning on speed, convenience, and a great digital experience. If we zoom out a little bit, over that same period of time, depositories went from 100% market share, complete domination in home equity, to 80%. That's 1 in 5 borrowers that have left to go to some of these fintech providers. And we've kind of seen this movie play out before in the first lien mortgage space with, IMB, the banks versus the non-banks, the IMBs. And currently we've seen that over time, the IMBs have chipped away at the market share of the depositories. And now that split is 60-40, 60 going to IMBs. And so we've kind of seen this movie before. So the question becomes, why are we seeing this erosion in home equity market share for depositories? And there's 3 core drivers that are really fueling this the shift. One is that speed is the actual new channel, and we'll talk about this here in a second. Digital is the expectation of speed. 2, speed captures need, and I've worded that on purpose in that order. Speed captures need, and I'll explain here in a second. And then 3, you can speed up. You need to be able to speed up the process, but without sacrificing on risk and quality control. So very interesting distribution here. I love this analysis, looking at the channel of production over the last 10 years. We can see that branch production went from 80% down to about 50%, with consumer direct channels, web and call center splitting evenly now at about 25% each. As we continue forward, the expectation is that the digital channel will continue to increase, and at the expense of both call center and the branch, because digital channels provides the ability to lower costs to originate, increase speed to close, and improve the convenience and the digital experience. Now, here's a very interesting analysis from Curinos. Really love this analysis. If you control for loan amount, FICO, LTV, DTI, and distribute by speed to close, you see a very interesting distinction in the percentage of draw at time of funding. Borrowers who close in under 20 days are drawing about 50% of their line at funding, versus only 18% of borrowers with longer closing timelines. These aren't riskier borrowers, same credit profile, but they're borrowers who need the money now and are looking to move quickly. And so when you elongate the origination cycle, you're not just slowing down, you're losing these borrowers to someone who can move faster. And so this moves the conversation from should we go faster to what is it costing us that we haven't already moved faster. In addition, we need to be able to facilitate speed without sacrificing quality. Technology over the last several years has improved significantly in this space, especially with the emergence of agentic AI. We are seeing great promise in being able to vastly reduce both costs and time to manufacture loans with agentic AI. We recently launched at Blend Autopilot. And Autopilot is an agentic tool that works across the loan manufacturing process, calculating income, checking guidelines, document verification, creating and satisfying follow-ups, and working with borrowers in real time to finalize fulfillment. And we'll see this here in a second with Natasha in the demo, but we're seeing great promise and great results already. 75% reduction in turn times, and in costs, but still being able to apply the same rigor on every loan as it moves through the pipeline. Same credit quality, but a fraction of the time. So, we've spent over the last few years working with banks and credit unions deploying home equity across the country. And what we found is that the gap between what fintechs offer and what most depositories deliver comes down to three things: digital application, automated decisioning, and digital fulfillment. These aren't nice to haves. Each one addresses a specific failure mode and component of the stack, and we see this transitioning across the entire industry. Let's jump in. So everything starts with an application. The first question every borrower asks is, do I even qualify? Right now, the typical answer is, well, you know what? Why don't you go fill out this form? Here's a homework project to come up with some additional documents, give those to me, and then just wait. The fintech answer is very, very different. They start with a soft credit pull, instant offer within minutes, in-app debt consolidation, showing borrowers exactly how can this line of credit change their financial picture in real time. The technology already exists today. These integrations are live and in place. The question is whether you've wired them together into a borrower experience that is competitive. One thing I'd flag here, the experience has to start by asking the borrower why they're pulling equity. Renovation, debt consolidation, maybe it's a life event. Stratmore found this is one of the most common failures across the industry. Lenders rarely ask, but you can personalize the experience and the offer if you don't know the need, and that's extremely important. Second, now once you have that in the application, the question is now how fast can you get to a yes? Here's what's easy to miss. The borrowers you're competing for right now have strong credit profiles around this, 740 FICO, healthy LTVs, healthy DTIs, solid incomes. They're not desperate. They could wait for the better rate, but they're choosing not to, and that's the key distinction. Traditional lenders running 30 to 45 day life cycle times are not losing on price. They're losing on speed. The borrower has already moved on. Automated decisioning is what compresses that timeline. Real-time DTI as the borrower selects debts to consolidate. No more manual handoffs at every step. And here's the strategic angle. The infrastructure you build to do this for home equity is the same infrastructure that will be needed in place when the refinance boom comes back. The 100 basis point drop that drives a 120% surge in refi volume, that wave is going to come. And lenders who have already put in place the digital decisioning live today are going to be well positioned to capture that next era of lending and as it evolves. And the third pillar now is where most lenders leave actually the most NPS on the table. And the data here is actually pretty stark. In a secret shopper of over 30 plus lenders, one finding really stood out above everything else. When borrowers had to chase a status update, NPS was a negative 57. When updates were proactive, that's shifted to NPS was actually a positive 85. That is a 142 point swing from one process decision. And when they asked borrowers to summarize the experience overall, the most common response was it felt transactional and impersonal. Borrowers don't remember your rate. They remember whether the process felt hard, whether they had to call 3 times, whether anyone told them what to bring or what was going to happen next, where are they in the process. Digital fulfillment really closes that gap. Automated document collection, status visibility built into the actual experience. Proactive notifications at every single stage. These aren't just user experience upgrades. They drive pull-through improvements that directly affect unit economics. We see lenders lose roughly about 35% of submitted applications in the post-submit phase, not at the top of the funnel, but after the borrower raised their hand. Process failure is the corporate every single time. And so with that, I'm going to hand it over to Natasha here to jump into the demo.
All right. Thanks, Nico. Now, Nico just talked about the three things that separate the winners, right? A great digital application, automated decisioning, and digital fulfillment. What I want to do here is now make it real. We're going to walk through what this actually looks like end to end. From the moment Andy opens his phone and wonders if he qualifies, all the way through signing his documents digitally. No branch, no waiting, no chasing a loan officer for a status update. Now, I'm going to show you all three pillars together because it's a great story, right? But I want to be clear about something before we start. You don't need all three to win. You don't need to transform everything at once. Some of you have an outstanding fulfillment operation already, and some have great LO relationships, but a painful digital application. The point of what you're about to see isn't do all of this, it's pick where the gap is and go. With this, with this notion, now let's start at the very beginning of Andy's journey. And let's start with Andy's first question. Do I even qualify? Now, this is the moment most lenders lose him. He opens a browser or an app, sees a long application, and either drops off or starts shopping around. What you're seeing here is a pre-qual experience. Andy enters some basic stated information, income, property value, and why he actually needs those funds. No hard credit pull. Within a couple of minutes, he actually gets a real conditional offer. Now, these are the three things I want to highlight here. How the experience actually led with his purpose, like debt consolidation, renovation, or he's taking out funds for some other home improvement projects before asking a single financial question. How the soft pull and real-time DTI calculates a conditional offer on the fly. How the offer is presented in a way that helps Andy understand what it means for his monthly picture. Now that was pillar one in action, and maybe a little bit of the pillar two, right? In under 5 minutes, Andy went from, I wonder if I qualify, to actually holding a conditional offer with a real number. Remember Nico's data point from Curinos? Borrowers who close in 20 days or less draw 48% of their line at funding versus 18% for those who wait longer. The pre-qual is what starts that clock. The faster you get Andy to yes, the more engaged he is, and the more he uses the product. And here's the thing, what you just saw is a complete standalone capability. If this is where you start, this is enough to move the needle. A great digital application with an instant offer in itself is a competitive advantage. Getting the borrower engaged at this time is the key to winning that borrower. Now, let's say Andy liked what he saw. He's ready to move forward. Now, what you're seeing here is of our full rapid HELOC flow where the automation really runs. And this is where many institutions are right now. They have got a decent front-end application, but the back end is where loans go to slow down. Underwriters are reviewing it manually. Docs are coming in through email. Income calculations are done on spreadsheets. The borrower applied in 5 minutes, and then he had to wait 3 weeks to actually get the funds. This video shows what happens when you close that gap. Every automated service running in the background, automated valuation, income verification, real-time compliance. The borrower experience stays clean, but behind the scenes, Blend is pulling together everything your underwriting team would have spent hours doing manually. The second thing that you will see in a minute is what Nico mentioned is autopilot. What used to take 20 minutes, being conservative here, of pre-underwriting review actually now takes 15 seconds. Income is auto-extracted, documents read and validated in batch, guidelines are indexed to your credit policy. Conditions are auto-generated, and this autopilot runs on every loan in parallel. So here you will see in a second where autopilot, and I'm going to quickly forward that part to where the autopilot actually happens right here. So this is where you're seeing those 20 minutes that we were talking about of being conservative of pre-underwriting review now taking 15 seconds, the income being auto-extracted, the documents are being read and validated, and guidelines indexed to your credit policy right here. Conditions are auto-generated, and as I mentioned earlier, it runs on every loan in parallel. Basically, it's like a support person being there 24/7. Anytime your borrower is uploading a document, it's validating it real time and extracting data from it. So now moving on to the next part right here. Christian, if I can move to the next screen, sorry. Yep. All right, so for HELOCs, one of the most important things Autopilot now produces is the pre-underwriting summary report. After each borrower session, Autopilot automatically generates a structured, branded PDF that pulls together the findings, calculations, and recommended next steps into a single summary document. It goes directly into the Loans Documents tab and can sync, and can basically sync automatically to the LOS. So the team has one consolidated output before the file reaches underwriting. What makes this specifically relevant for HELOC is that the report is not just a generic recap. As you can see here, it now includes a HELOC-specific custom guideline check, including items like footprint states, property type eligibility, lien position alongside the determination itself. It also includes the application data that supports the findings, which gives the loan team clearer context on why the loan passed or failed. The value here is speed and clarity. Instead of asking an underwriter or loan officer to manually piece together what changed across documents. Now, that is what compressing a 30 to 45-day process into hours looks like. The borrower never felt the difference, but your team does, and so do your unit economics. 35% of submitted applications are lost post-submit, like Nico mentioned before, not because borrowers changed their mind, because the process wore them out. Autopilot eliminates the handoffs and the waiting. The loan doesn't sit, it moves. And again, if pillar 2 is where you have the biggest gap, that's where you start. Some lenders already have a strong borrower-facing application. What's killing them is the back end. Autopilot is available independent of the full journey. You can layer it on top of your existing flow. The last mile, Andy is clear to close. His offer is set, documents are verified, everything is in order. Traditionally, this is where you would schedule a notary, find a time that works, get everyone in a room, and sign a stack of paper. And for some institutions in this room, closing is actually where you are the strongest. You have invested in your closing operations, you have notary relationships, and you have a very good process. The question is, does that approach or does that process match the experience Andy just experienced in the application? Because if the app was fast and digital and the closing is a 2-week scheduling exercise, you've broken that promise. Ron is how you keep it. Andy closes from wherever he is on his schedule with a live notary on screen. The closing is the finish line. It should feel like the rest of the experience. The closing is the last thing Andy remembers. If it's hard, printing, driving, waiting, that's the impression that sticks. If it's this, 15 minutes on his laptop and he's done, that's a borrower who comes back for the refi, who refers a friend, who doesn't leave for the fintech next time. And this is why retaining servicing and not outsourcing home equity origination is really important. And just like the first 2 pillars, if fulfillment is where you're losing borrowers, this is where you start. Ron doesn't require a new application or a new decisioning engine. It plugs into the process you already have. All right, I am going to, this is what you're going to see, the whole remote online closing session right here. And we are not going to go through the entire signing room experience. So I'm just going to quickly fast forward through this entire remote signing experience. Now, moving on to the next part of it. Now, as a closing, as part of our demo here, 3 videos, you saw 3 pillars, 1 end-to-end experience, right? But here's what I want you to walk away with. This isn't a 3-year transformation program. Every institution is at a different place. Some have a gap at the front of the funnel, some have the application, but the back end is where loans go to slow down. Some close beautifully, but lose Andy before he even gets there. The answer isn't the same for everyone, but the starting point is pick the pillar where you're losing the most borrowers and go. You can add the others as you go. The lenders Nico mentioned who are winning aren't the ones who had the most ambitious roadmap, right? They're the ones who actually went live first and started learning on real data. Speed beats perfect, out of the box beats custom, and any one of these pillars live today actually beats waiting for all 3. Now I hand it back to Nico to close out our session here.
Nico, you're muted.
Dang it, I had a good talk track. All right. Right, pick it up. Jose, you got this one. Awesome. Well, that was really exciting, Natasha. Thank you for walking us through that. That was great to see it in action. And so for all of us now, what this comes down to is that there's really 3 choices in front of us. One is do nothing. This leads to continued erosion of our share. 2, outsource to the fintechs. But this is just giving up our relationships and our customers. So that's not a great choice. 3, we could optimize for speed. Own your digital origination, your rates, your servicing, your customer. And this is where I think all of us on this call in this industry can work together to create the next big opportunity. Again, thanks everybody for hanging out with us. If you'd like to learn more about any of these features and capabilities that we shared today, please reach out and we'd be happy to walk you through in some more detail. Thanks again.